but I can probably just as easily lose $3. That's what we talk about when there's an increase in volatility, which there has been over the last 3 months. There has been a lot of volatility. Trade smaller positions. You might be able, I'm putting my fingers together, you might be able to, I can afford to buy 1,000 shares. I got the money. You might have the money. But when I tell you bought 1,000 shares of XYZ stock and the stock's down $10 today, and you're like, on 1,000 shares, I just lost 10 grand today. I can't afford that because it's giving me a stomach ache. That's what we talk about trading smaller position sizes. You don't have to trade 100 shares of every stock. You don't have to trade 1,000 shares of every stock. We want you to trade a position size that's comfortable for you. And those are going to be some of the things as you go forward, as in your evolution to becoming a successful trader. Those would be some of the things that we want to talk about. Now, when we talk about if you're right and consider scaling in and out of position when market volatility is high, I might say to you, I want to buy 500 shares of whatever stock, XYZ. And this stock has a lot of volatility. It moves from high to low every day. It's a $100 stock. I made it up. It's a $100 stock. And the high today might be 104, and the low is 95. That's a $9 swing. So, all right, I can afford 100 shares, right? I can afford 100. I can afford 100 shares if a $100 stock is $10,000. 500 shares is 50,000. Pretend I can afford it. Pretend I can afford it. If I really want to buy 500 shares and I know that the stock is highly volatile, maybe I start out with 100 or 250. Give myself, if my true desire is to get to 500 shares and I can control that risk, and that's an okay risk for me, give yourself some room to be wrong. So while we might be trading smaller positions, even with our smaller position, we can scale in and we can scale out. And what that means is we start with maybe 100 shares. I know I want to get to 500, and I'm going to start to buy, 100 here. Maybe if it goes down a little lower, I can buy another 100. Even if it's going up, I can continue to add to my position as the stock's going up. The same thing on the downside. You've got a great position. You were lucky enough. You bought something on March 17th and you bought the stock at 100 and now it's at 170. That seems to be possible out there in the market right now. So when you see that stock at 170, you're like, oh, just sell it all. No, don't sell it all. Maybe scale out of the position. Maybe take 200 of the 500 shares that you bought, take them off the table. And then if the stock starts to go higher, you can allow it to breathe while taking less risk in the portfolio. Or unfortunately, if the stock starts to go down, you're like, oh, at least I made a small sale up higher. Again, these are just ideas that we have collected over years in talking with our clients. Consider using limit orders. Hopefully, everybody is kind of familiar with the order entry box on any of the platforms you're using, whether you're using www.schwab.com, StreetSmart Edge, your iPhone, your iPad. We talk about using limit orders all the time, especially when it's overnight from like, I live on the East Coast, so the market closes at 4 p.m. Eastern time. And I might be looking at a stock, I don't know, it's 9 o'clock tonight. And I see that the stock closed at $50 a share. I'm like, oh, I would love to buy that stock tomorrow morning at 50 bucks. Just because it closed at 50 at 4 o'clock does not mean that tomorrow morning you're going to wake up and if you put an order in tonight that you're guaranteed to get 50. You're guaranteed nothing. The stock closed at 4 p.m. today at $50 a share. There could be good news out on the stock tomorrow morning. There could be good news out on the market. And the stock, because the demand for that stock, could push the price a little bit higher during the course of the overnight hours. And maybe tomorrow morning it opens at 52. Now, you might be mad. You're like, hey, I put in an order to buy it at the market. I thought I was going to get 50 and you got 52. That's why I kind of tell all the clients that I meet, let's start using limit orders and control the price that you're either willing to buy the stock we're obviously trying to sell the stock at. Limit order says the price that you're willing to accept. A market order, we guarantee the execution. We guarantee you're either going to buy the stock or sell the stock, but we don't guarantee you what price. So market orders have a lot of volatility in them, especially from the overnight session, meaning from 4 p.m. East Coast time today till 9:30 a.m. tomorrow morning. There's a lot of things that can come out. News in either direction. Good news about the stock, bad news about the stock, or maybe a competitor of that particular stock that you're interested in buying or selling comes out with good or bad news that could adversely or positively affect your stock. So we want to try and take a look at the differences of using a limit order, especially in those hours, versus just putting in a market order. And again, market orders do not guarantee the price that you buy the stock at. Limit orders do, and the same thing for the sell side. Just checking to see if there's any questions here. Okay, we're same ones I've been seeing. Okay, let's get back to it. Trading the trend. One of the oldest adages on Wall Street. Again, we're talking about 8 steps to keep your trading on track. And I'm saying trading, I didn't say investing, I said trading. And one of those tracks, 8 steps, one of those 8 steps is trading the trend. The trend can be your friend. Don't fight the market. We want to follow with the direction of the market is going. Right now, the market is going up from those lows of March 17th. Right now, we're up over 35% from the lows. Though the trend in the immediate short term has been upwards, right? Now we've moved a little sideways over the last week, but the trend can be your friend. And what I was saying earlier in the seminar is just because I think the market, quote unquote, might be overbought, nobody cares what I think, right? So then, I'm going to start shorting everything. That doesn't make sense. The trend is the market's going up right now. And I can either be bullish on the market and participate and maybe continue to join in. I hope that we're all right when we join in. But trying to fight the trend in a stock is a really hard game. Take a look at any of these super strong stocks. I'm sure we've all heard of the word Amazon, right? If you think Amazon is overbought, you're entitled to that opinion. But the point is the stock has been going, straight up. The lows from COVID was 1,600, and now the stock's knocking on the door of 2,500, a little less than that today, 2,470 or something like that. The idea is that's been a tough trade to go against Amazon. If you don't like Amazon, then don't play in Amazon. But right now, the trend, coincidentally, has been going up. Now, not to say that the trend can't turn, and you might be right, but you might not be right until another 200 points higher. And then now you're fighting it, right? You're fighting the trend. So we want to kind of go with the current chart pattern that we're looking at in the stock. That's the trend. Whether it's up, whether it's down, whether it's just moving sideways. Now, sideways, all right, then you're not really fighting the trend, meaning it's bouncing around between 2 points. Pick a stock, $25 and $30. The stock's like a ping pong ball. All right, and it's 25, 30, 25, 30. Over the course of the next 2 months, it hits those prices 3 or 4 times. That's a range bound stock, no trend. But that trend of stock going higher, higher highs, higher lows, and that downward trend, lower highs and lower lows. Unfortunately, you'll make your life easier. I don't want to say unfortunately. Fortunately, you'll make your life easier if you can just kind of follow the trend. And that'll help you become a more efficient trader. And then we write here, obviously, don't focus on market tops and bottoms. It will seldom work to your advantage. Well, that's always hindsight, rear view mirror, because you don't know where market tops are or market bottoms are, right? Well, on March 17th, did you know that was a market bottom? Now we know it's a market bottom because we see where the market has come from. But it's hard for you to say, hey, the market should stop going up here and it should stop going down here. That's why when we talk about on charting the markets here on Schwab Live Daily. We talk about support levels, resistance levels. Trader Talk in today's market with Kevin and Lee in the morning. We talk about where there's support, where there's resistance. We use those things so we don't have to focus on tops and bottoms. We can kind of get an idea from the stock chart, not from intuition. We're trying to find an area. Stocks that can make a high and it's making a new high every day of the week. All right. Stocks can make 52-week highs for a couple of years in a row. A few years ago, Apple made a new high almost for 2.5 years in a row. So yeah, don't think that just because Apple's at a high, it's not at an all-time high today, but if it was, oh my God, it's got to stop going up higher. Just because you think that, it doesn't mean that. We got to have sound reasoning, and sometimes that sound reasoning comes from the chart. So we do offer a lot of great information on following those trends, again, on a lot of the shows that we have here on Schwab Live Daily. So when we're building a portfolio, right? We've talked about a couple of ideas on trading the markets. Maybe I'm just not the best stock picker. And I don't know the difference between all these individual stocks. So I'll give you an example of what an ETF is, certainly. But ETFs are part stock, part mutual fund. So ETF, the word ETF is exchange traded fund. These can be low cost portfolios, low cost ways to build a diversified portfolio without the individual challenges of picking stocks. So you can get full exposure to a sector or an industry. Again, an exchange traded fund is a basket of stocks. Part stock. Why is it part stock? Well, because they have pricing that moves all day long, ETFs. Unlike a mutual fund that's priced one time a day, ETFs are continuously priced just like every stock out there. A mutual fund has a manager who is buying a basket of stocks, and that manager is trying to pick the best stocks for the best rate of return for you. And sometimes he's not so cost conscious, might give you some taxable events. An exchange traded fund is kind of like a mutual fund, and it does own multiple stocks. There's not just one stock in there, there's multiple stocks. However, it's tied to an index, maybe an index that you might see on a Bloomberg terminal, an index such as the S&P 500. Because it's tied to an index, we can eliminate that mutual fund manager. That mutual fund manager is what drives the cost, the expense ratio in a mutual fund, and ETFs have a much lower expense ratio because they don't have that manager that they're paying. They have it based on an index. The stocks are there. They're not actively managing, buying and selling the stocks in there. So that gives us the opportunity to make these a lower cost of entry. ETFs have a much lower expense ratio than mutual funds. So we can build a diversified portfolio of stocks with an exchange traded fund. It'll allow us to test different areas of the market without buying individual stocks. So early on in COVID-19, oil was going crazy. Oil was going straight down. We were in the mid 40s, and then we hit down all the way. I saw $18 a barrel, and then we saw a negative day on a price for a brief day. But the point is if I wanted to buy some oil stocks, I'm going to give you a couple right now. Chevron, ExxonMobil, Schlumberger, British Petroleum. They're all, I'm just going to call them good stocks. They're all good stocks, but I don't necessarily have to know the difference, which one is better. I just know that whenever I pull up my car to a gas station, one of those companies is there. So if I wanted exposure to oil, I really didn't know the difference between all those stocks that I just said, you could buy an oil services based ETF, XLE as an example, and that would give you exposure to that sector without you having to pick all the individual stocks. It's going to give you all of them. And then at the same time, I don't have to worry, did I pick the right stock? Because you know what'll happen. I gave you those four stocks, ExxonMobil, British Petroleum, and Chevron. You know what'll happen. I'll buy ExxonMobil and Chevron will go up, or vice versa. You know how we always feel that we're the bad luck omen of buying a stock. So the idea is when we buy a stock, we can get some, when we buy an ETF, we can get exposure to all of those stocks without the stress of making sure that we pick the right one. The good advantage of doing that through an ETF is you get all of them. Since there's no active management in there, you know that you're going to maintain a position in all of those stocks as well. So these are some of the good things that we have on our website, on our Schwab ETF sectors. So I will going to show you that in 1 second. Should I invest in ETFs though, before I go there? Should I invest in ETFs that are actively managed? Listen, actively managed ETFs, they're a very small portion of the ETF market that's out there right now. I'm not going to say that there's anything wrong with them. The general world of ETFs is probably 95% of them are passively managed, whereas there's about 5% that are active. The one thing I would tell you, once you're starting to get into the actively managed ETFs, you might want to consider looking at some mutual funds out there, because you're going to get the same benefits of that, because you're still going to get a tax bill on an actively managed ETF. And, those would be some of the things that I would take a look at. What is your opinion on inverse ETFs as a hedge? Again, that gets a little out of the scope of today's thing, but I will tell you, inverse ETFs, I'm not talking about the leveraged ones, not the ones that are 2 times and 3 times. For those of you who have never traded an ETF, they do have ones that'll take on a little extra risk if you're so positive of, things are going to go up or go down. But ETFs in my opinion, ETFs, if you stay with the single ETFs, even, hey, I think, the market's going to go down, there's single ETFs that you can get that opinion. It'll look like you just own a stock and it'll only go up if that particular part of the sector goes down. I think they're okay. The leveraged ones are another conversation. If anybody's thinking about trading those leverage ETFs, I wouldn't urge, but I would implore you to reach out to your financial consultant if you're not familiar with those, and really gain a strong understanding of what you're actually doing. Because those leveraged ones use futures contracts, and if you're not familiar with that, I always encourage our clients to know what you're buying, to know what you're investing in. So nothing wrong with the inverse ETFs. Just I like the ones that are single, not the leveraged ones. And the leveraged ones, there's a place for them, but I think you need to just be more educated on how they work. Okay, let's move this along a little bit. So if you haven't really seen our ETF Center on Schwab.com, we do offer a multitude of research that's available. So on our main tab, research up top, sub tab, ETFs, it might even say exchange traded products. And then we give you an overview of that page, and it brings you on there. And you can see all the Schwab ETFs, which are some of the lowest cost ETFs in the industry. We give you a select list where we pick the ones in certain parts of the market, large caps, small caps. We'll give you ones that we would quote unquote recommend. We have a great ETF screener where you can build criteria for something that you're looking to find in a specific sector of the market. How did I know that XLE was the ETF for the oil service sector? Well, yes, A, I knew that, but B, I could have found, hey, on our ETF screener, I could have said, hey, find me an oil service ETF. And now more than one would have come up, but then with a little criteria, you might have put in and found the one that's called XLE. But again, we do run a lot of great research on our website on ETFs as well. See here, we got one more slide of our ETF page right there. Perfect. So we can build multiple things. Now, this is an ETF page for the technology sector, just as an example, and it looks just like our stock research page. and you get a summary page, and it gives you, 52-week high, 52-week range, the average daily volume for that ETF. Over here on the left-hand side, we can show you not just the top 10 holdings, we can show you every holding as of yesterday afternoon. So one of the things that I love when I compare ETFs to mutual funds is I love that I know exactly what stocks are in that exchange traded fund versus the mutual fund that will primarily, it's a generalization, but primarily only show me the top 10 stocks of about 6 months ago. Not the top 11, not the top 20, the top 10, and it's generally about a 6 month hold period, meaning they've already had that position for 6 months. This is what it was 6 months ago. ETFs will show you what it was. And again, they don't reconstitute ETFs unless you're in that very small portion of actively managed. And again, I said about 95% of ETFs are not actively managed. You can look at these ETFs when you're looking at the ETFs, you see exactly the holdings that they have, the exact percentages, and you might say, yes, I want that, or no, I don't. And that's your choice. But I like that you get the opportunity to see what's inside those ETFs. Over here, we give you a Morningstar rating on the ETFs. And one of my favorite things about on our Schwab, on our webpage about the ETFs is this one: historic return above average, historic risk below average. That is a really good indicator for what you're buying. I would love to find historic return above average. I'd love to find high rate of return, low historic risk. That'd be great. You're not going to find everyone that's doing that, but for me, that's a really good barometer of what I'm buying. I like to know, and I like all of my clients that I speak with, to really understand what they're buying and the risks that they're taking inside those portfolios. That's one of the really nice things here. Take a look at the next slide. Identify your exit strategy. Well, using some of the technical analysis that we talked about earlier, support, resistance, if a stock breaks down below a support level, I might want to start setting a spot where I'm willing to get out of the stock. I got to use the word stop order. Now, we'll talk about stop orders in a couple of seconds, but I'm going to have to stop myself out. These are trades. The name of the seminar is 8 Steps to Keep Your Trading on Track. It didn't say 8 steps to keep your investing on track. Again, investing is more of a longer term view. Generally speaking, I call that a year. If you're going to hold the position less than a year, you're kind of trading it. And again, there's not a technical definition that you're going to be able to look up in the dictionary, but that's pretty much the way this industry works. Either you're investing in it for the long haul, year or more, or anything that's less than a year is typically considered that trading. And in that trading, we want to identify, where am I going to get out of that stock? And where am I going to stop myself if I'm continued wrong? So the good one, identify the profit. None of us, hey, yeah, I'll take profits. I'm okay with that. But I want to identify my losses of where I would potentially get out if I was wrong. Setting bracket orders when placing opening trades. Well, what does that mean? We have the ability to set bracket orders on our Street Smart Edge platform. And what that means is, hey, I just bought a stock at 50 bucks. If I buy it at 50, and I'm making up some prices here, if it hits 55, sell it. That means I'm willing to make 5, and I'm just using an example so we can keep our numbers straight. If it hits 47, sell it. Now, I just bought the stock at 50. But on our systems, you can put in, on our Street Smart Edge platform, you can put in a good sell and a bad sell at the same time. We don't know which one's going to happen first. Bought the stock at 50. If it hits 55, sold. If as soon as I buy it at 50, it goes straight to 47, unfortunately, sold as well. Now, that sold is at a loss, but the idea is take your emotions out of that trade and know where you're going to say, I'm uncomfortable with this position. And that's when you're going to get out of that position. Those would be 2 things that I really kind of key in with our clients, is understanding where you're going to get out from the good side and unfortunately where you're going to get out on the bad side. Now, when we talk about that, we talk about the word stops. There's two types of stop orders that are out there. And these are risk management techniques. A stop, the plain word stop, and then there's one that says stop limit. The technical definition of stop. Stop order, we guarantee execution. What does that mean? We guarantee that you're going to sell the stock. We just don't guarantee the price. So what does that mean? I just bought a stock at 50. My stop price is 45. That means if the stock hits 45, as soon as it hits 45, we create a market order and sell it at the next available price. Well, all right, that makes sense. Well, let's talk about how it works. Now, the market's open right now. The market's open right now. So when the market's open right now, if my stock, pretend I just bought it at 50, unfortunately it's been moving against me, it's at $45 and a nickel. 45.05, 45.04, 03, 02, 01 at 45. As soon as it hits 45, that just becomes our trigger. And it sells it at a market order. Now we might get 45, we might get 44.99, we might get 44.98. You might even get 45.01. At the end of the day, you probably don't care because you just said, hey, sell me out. That's a plain stop order. However, that order has a negative side to it. The negative side to a stop order is the stock could have closed at 45.25 today. 4 p.m. today, it closes at 45.25. After hours, some bad news comes out on the stock. Tomorrow morning, the stock opens at 38. That happens every day of the week. On a stop order, you had your stop price at 45. We guarantee execution. We don't guarantee price. If tomorrow morning the stock is trading at 45, at 38, you are executed at 38. It closed at 45.25, opens at 38. You were executed at 38. Stop order guarantees execution, not price. If you use the word stop limit in that scenario that I just described, you would still be waving your hand trying to sell it at 45 because it closed at 45.25 and you said, hey, my stop limit price is 45, but because of bad news, it opened at 38. All right, you didn't sell the stock. You still own it, so you now have a new decision to make. But if the stock bounces back up to 45, we're going to sell it for you. Otherwise, you're still going to hold on to that position. So just some of the things I want to make sure that our clients are aware of when they're looking at these things. This slide goes here without saying. Use caution when trading on margin. Listen, nobody's forcing you to take more risk in your portfolio. When you're, again, on margin, you're borrowing money from Schwab. My account is worth $100,000. I just bought $110,000. I know that Schwab is loaning me $10,000. Well, that's great if the stock is going up. But if the stock is going down, you're paying us interest on the $10,000 that you bought. The losses are coming out of your $100,000, but because your position is a little bit bigger, now those losses seem to be magnified. So again, we don't encourage anybody to trade on margin here. But if you've never traded on margin, certainly have a discussion with your financial consultant. Guys like me, guys like Lee on our call, we can explain to you the risks that you're taking on. Because you're taking on some extra risk in your portfolio. And one of the last slides here, when in doubt, wait it out. And this is one of the things that clients really get stuck on is, sometimes I don't know where the market's heading. And I'm reading the slide, but yeah, that's perfectly okay. Because the truth is, as much as as much as I think I know about the market, or you think you know about the market, sometimes we get confused. And when the market was having a great beginning of the year, then shoots down almost 35%, and we're up 35% from those lows, people become confused where maybe they are in the market. And guess what? That's okay. It's common. It happens all the time. So if that's the case and you're not sure where we are, that doesn't mean you sell every stock, and that doesn't mean you buy more. Maybe you stick with what you got. Maybe you have to reduce some of your position size. But the point is don't feel that you always have to be doing something in the market, especially in this is, again, trading topics, 8 steps to keep your trading on track, this might be a spot where you might have to refigure out what you're trying to do, get a new spot in the market, and then, all right, hey, I'm going to lighten up my positions. Hey, I'm going to buy more. But don't feel the pressure to constantly be in if you're at a spot where you're a little unsure. Nobody's counting, right? So it's one of the things that I try to get across with our clients. Again, hopefully I was able to give you guys some good ideas here. And let me just recap them real quick. But one of the things that one of the things again that I talked about today, we talked about 8 steps to keep your trading on track. We talked about sticking with your investment plan, talked about trading smaller positions than usual, talked about the difference of using a limit order versus a market order. Trade the trend, make your life easier. Following the trend, try not to go counter to the trend. ETFs make it easier because I don't need the burden of picking the best stock. I gave you guys an example of the oil service stocks. Hey, I just think oil is going to go up. I can buy an oil service ETF, and that gave me the exposure that I was looking for without picking the right stock. Talked about your exit strategy. A good sale, profitable sale, we seem to all be okay with. We talked about the differences between a stop and a stop limit order. Talked about margin very briefly. And margin is just you're taking on, we're loaning you money. Your brokerage firm is loaning you money, and we're giving you some idea, we're giving you the ability to take on bigger positions, but you're also taking on bigger risk. And then I also suggested, hey, it's okay not to know where, you're feeling on the market 100% of the time, every day of the week. And we just try to find a spot where we're actually comfortable in the market. So sometimes it's okay to wait it out. Again, I always appreciate talking with our clients. If you do ever have any questions, all of our slides today are at the bottom of the screen. The slides are available via the resource tab above the video player. So you can certainly get those slides. It's been great hanging out with you. Up next, we've got Options Market Recap with Nate Peterson and Jeffrey Abelos, who is a coworker of mine out there in the San Diego side of the country. So again, I appreciate everybody listening. I appreciate all the questions that you guys had today. If you guys have any questions, certainly let me know, but thank you very much.
When it comes to identifying trends and trying to pick tops and bottoms, the MACD indicator can be a useful tool. MACD stands for Moving Average Convergence Divergence, and it is based on the behavior of moving averages. Notice that when a stock or index begins to rise, how the faster moving average is above the slower one. What this means is the more recent prices are getting stronger than prices in the past, it could mean an uptrend is beginning. The reverse of this, of course, is also true. When a faster moving average drops below a slower one, what that means is that more recent prices are getting weaker than prices in the past. It could mean that a downtrend is beginning. The MACD indicator is based on that behavior. It has 2 lines in its composition. The first we call the MACD line itself, and it is the red line in this indicator. It is simply the difference between those 2 moving averages on the chart. So when the faster moving average is below the slower one, you can see that MACD is negative. However, when the faster moving average is above the slower one, you can see that MACD is positive. The second line in the indicator is what we call the signal line. The signal line is simply a moving average of the MACD line, and it is the blue line in the indicator panel here. When the MACD goes above its average price, which is the signal line, it could mean that prices are getting
below this price, it triggers a market sell order. Widely recognized as the quickest way to exit a trade, market orders are filled at the next available price. But stop orders will not protect you from a gap in prices during market hours or from one regular market session to the next. Now, a stop limit order is like a stop order, but with an extra layer, a limit price. Again, you set the stop price where you want the sell order triggered. But here's where they differ. You exercise a measure of control over the trade by also setting a limit price. Instead of the trade being executed at the next available price, you specify the lowest price you are willing to accept. Here's an example of what can happen if you set a stop order without a limit price. Let's say you hold shares of XYZ at $100. Your analysis suggests that if the price falls to 98, it could continue to move lower. With the intention of limiting your downside risk to $2 per share, you set your stop at 98. The stock closes at 100, but due to a disappointing aftermarket earnings announcement, the stock opens the next day at $90. Because the stock has traded below your stop price of 98, it triggered a market sell order. The good news is that your trade went through. The bad news is the price at which it executed was near 90, not near the 98 you anticipated. And if the price bounces back during the day to say $96, you might be sorry that trade went through. The stop limit order can help address this scenario. Let's use the same premise with you holding shares of XYZ at 100 and setting a stop order at 98. But this time, you're also going to place a limit at the minimum price you're willing to sell these shares. Let's say 95. In our first example, you were sold out at 90 because once the stop was triggered, it became a market order and executed at the next available price. Using the stop limit order, your order is still triggered, but doesn't execute unless the price rallies and hits your limit of $95. In this case, it works well. The price rebounded and the limit price protected you from taking a greater loss. You might think this is a better approach, but what if that price didn't rebound and instead continued to fall, hitting $85, $80, $75, or even lower? Now you're left holding those shares while their market value evaporates. So when does it make sense to use a stop versus a stop limit order? A stop order typically ensures that your trade is executed, but it does not guarantee the price. It can provide protection during regular market hours, but in a volatile market, you have no control over the price you'll get, and you may face a larger than anticipated loss. Use a stop order when you are more concerned with getting out of the trade and are not as concerned about the price. A stop limit order typically ensures that you get the price you set, but it doesn't guarantee that your trade will go through. As a result, you could be left holding shares worth far less than you anticipated. Employ a stop limit order when you are willing to hold the shares if you can't get your desired price. For more information, watch our other Trading Up Close videos and subscribe to our YouTube channel.
So Schwab just taught me about an iron butterfly spread.
Nice. I just tried.
Indicators, proprietary research helps you see the full picture.
Speaking of...
Trade up to Schwab. The gut check you want, the intel you need.
Earnings per share, or EPS, is one of the most widely used ways to gauge company profitability. To calculate, divide the company's profits by the number of outstanding shares. EPS matters because strong earnings tend to drive the price per share up, and that's good for investors. Earnings also generate money the company can reinvest in growth. But EPS has limitations. If a company uses earnings to buy back shares of its own stock, there are fewer outstanding shares in the equation. That drives the EPS up without any actual increase in earnings. EPS also doesn't consider outstanding debt, or that two companies might have the same EPS, but one company used less capital to generate the same profits, indicating it might operate more efficiently. So while EPS is a fundamental factor in assessing stock value, it's most useful when considered along with other metrics.
Hello, and welcome to the Quick Start video where we cover Screener Plus and Sectors tool available on Schwab's Street Smart Edge platform. The Screener Plus tool can help you identify securities meeting certain criteria by setting up custom screens, as well as providing a variety of predefined screens. You can find the Screener Plus tool by looking in Launch Tools and clicking on Screener Plus. Let's start with predefined screens. The predefined screens can be found along the left rail. Here you can find a variety of equity and options screens. You can find top volume, gainers and decliners, high-low for the day, performance by sectors, and many others. Click once on a screen and its results appear in the body of the window as a new tab. From there you can use actions to print or export those results, or you can click on Save as Watch List to quickly create a watch list out of the results of your screen. Click on Criteria to view the criteria used to produce the current results. Let's talk about custom screens. You can create a new screen by right-clicking on the plus sign to the right of the tabs. Here you can select from popular fundamental and technical criteria. Alternatively, you can easily edit predefined screens by going to the Criteria tab and making changes to that screen. You can name your screen and click Save Screen at the bottom to save those changes. Let's talk about the Sector tool. If you are interested in performance data for sectors, you came to the right place. Schwab has GICS, or Global Industry Classification Standard, for sectors, industry, and sub-industry. You can drill down to the sub-industry to see the individual securities and even save them to a watch list. This concludes the Quick Start Guide for Screener Plus and Sectors tool for Street Smart Edge. Please check out the Learning Center and the online help manual, both of which are located under the Help menu. Additionally, you can visit the calendar on schwab.com/live for a schedule of upcoming live platform videos. Thank you for choosing Charles Schwab and have a great day.
Price to earnings ratio, or PE, is a way to value a company by comparing the price of its stock to its earnings. The PE equals the price of a share of stock divided by the company's earnings per share. It tells you how much you're paying for each dollar of earnings. Low or high PE ratios aren't inherently good or bad. When a PE ratio is low, it could mean that investors are losing confidence, selling shares and driving the price down, while earnings hold steady. The PE could also be low if the company's earnings grow quickly, before investors notice and start buying shares, driving the price up. Similarly, a high PE could result if investor excitement drives the share price up, while earnings remain low. Or that high PE may be justified if the company is poised for growth. Make sure you research companies carefully. Compare the company's PE to others in its industry, and analyze any inconsistencies. PE is a complementary tool. Use it with other factors and information when evaluating a company's stock price.
Live from Schwab Studios, this is Schwab Live Daily.
Good afternoon, everybody. Welcome to today's option market recap for June 2nd. We made it through May, Jeffrey. There, congratulations. I mean, June's not off to a great start, but each month that I think we get past, it's a small victory there. Welcome to the show, everybody. This is your host, Nathan Peterson. Of course, as you heard, my colleague, Jeffrey Abelos, frequent guest on here, regional investment strategist, is joining us. Jeffrey, you're out in Phoenix. How are you doing today?
Yeah, I'm doing good. I mean, it's now that it's hot in Phoenix, but it's a dry heat, I think is what they like to say. Otherwise, things are pretty calm, but it looks like the world around me is starting to open back up a little bit more. How about you in Austin?
Yeah, it is opening up. I mean, I think like most cities, we had some of the, the civil unrest, the protests going on. That certainly flared up over the weekend. Yeah, gosh, I'm sure you've seen a lot of the memes about 2020, just in terms of the unusual nature of just so many of these flare-ups of various issues that I guess we're becoming less shocked by, some of the headlines that come out or some of the, the circumstances. So, yeah, I mean, it certainly it's tragic to see, what's going on with a lot of that violence and everything like that. And then at the same time, it's just, I'm just kind of rolling with it because you have no other choice, really, right?
It's sort of like when Trump first took office and he was tweeting, everybody was like, okay, wait a second, this is ground, gosh, this is going to happen. And then after a while, you kind of become numb to it and you don't react as much. So it really takes more for us to have a reaction to it. But you isolate this in any other year and that would have a dramatic impact on the market.
Oh yeah, and absolutely. And I think the same thing you could say for the trade wars. When he first announced that on that February, I think of 2018, then boom, market didn't like it, took a big hit, still reacted, and then just the subsequent tweets and riffraffs got less and less of a market reaction. So I don't know if it's a good thing or a bad thing, but it's making it. They called it at times a Teflon market, but I don't want. Hopefully, we're not too desensitized, or Liz Ann just had an article about being disconnected from Main Street. Hopefully we're not getting too disconnected, but certainly markets have been in that melt-up mode, and so we'll definitely talk about that today. Okay, well, let's get into the disclosures, guys. As you can see here, there is this document entitled Characteristics and Risks of Standardized Options. If you scroll onto your disclosures, you can get a copy of that document. If your option's approved, you have already received it, but keep in mind that options are a different product. They have risks that you're not going to find in stocks. You're not a shareholder if you own an option. You do not get dividends. You do not have voting rights. You do have an expiration date with all option contracts. So please click on that document for those types of risks and more. Jeffrey and myself will be discussing some technical analysis in here. Please know that Schwab does not condone that as your sole means of investment decision making. We'll also be discussing individual securities. Don't take anything we say as a recommendation. We're here to educate, to inform. Happy to take your questions. Happy to discuss strategies. We'll provide our insights without going into a specific recommendation. But that's kind of what we do here on this show. And then lastly, there's an HD icon in the bottom right-hand corner of your screen. If you click on that, you can get crisper resolutions on your charts. Here's just a breakdown of the show. We'll start at the top, look at the major indices, move into some of the activity that we found. Take your questions, so keep that coming in. We got some earnings announcements. Zoom is going to be an interesting one today, Jeffrey.
Yeah.
Just because that stock has been, I think it was up like $25 yesterday or something, if I'm not mistaken, and they've got earnings after the bell. Wouldn't be surprised if some short covering was in play yesterday there, but that will be an interesting one. We've also have CrowdStrike and Ambarella. That's a chip company. So never a dull moment, my man.
Yeah, that's what I love about the markets is that we've always got something exciting to look forward to every single day.
Yeah, that's right. That's a good point. That's a good way to look at it. I like that. Certainly it makes our job easier in terms of tapping into some topics. So so here we are, Jeffrey. We were talking before the show. So S&P, off the highs. All three are off the highs. Let's take a look at the NASDAQ because I thought perhaps we could, if you want a reason to sell, on Monday morning coming in, the futures were weak on Sunday. They were already positive when I woke up on Monday. If you wanted a reason to sell, you could have been given one on Monday. They didn't really seem to do that. If you wanted a reason to sell today, it looks like we started to get, some of this selling pressure in the NASDAQ, mainly out of some of those large cap techs and some of those growth stocks that have been seeing some of that momentum. And sure enough, Jeffrey, they just kind of stepped right in and began buying that. I mean, it lasted about, I don't know, an hour before the buyers stepped back in. What do you think about the market action in any of the indices, or overall? What do you think?
Well, that intraday one is captivating because you've got, I don't recall an announcement happening at around that time. So, I was thinking it would just continue on with what was happening yesterday, but right out the gates there, we just started shooting down. Obviously, the market digested it a little bit and decided it wasn't that bad. No, the NASDAQ, keep in mind, does have a very heavy weighting towards Amazon and Microsoft. So as long as those two components are doing well, the NASDAQ seems to continue its flurry of activity as it goes higher and higher. And now we're almost to, as Nate's showing you here, we're almost up to the highs we had back in February. Yeah, there's your Amazon, just continues to break past those old highs. NASDAQ is just off of that February high point. And I know that everything around me right now looks just like it did back in February. Said nobody across the country.
Yeah, nothing ever really happened, right?
Yeah, I mean, it is a fascinating situation that we find ourselves in. But when kind of like when you first learn about the markets and you say, okay, the NASDAQ is the tech component. Tech stocks are doing good. Not every tech stock's doing great, but when you look at the major components, because there is a weighting to the NASDAQ, you've got Microsoft and Amazon heavily weighted in that space. That's why it's doing so much better than an overall tech sector equal weighted product might do. So very important as you're looking to invest or trade, make sure you know what you're investing or trading in. USO comes to mind from back in March, and that was a bit of a sticky situation for a lot of folks who tried to get in that trade because oil prices went negative and didn't know that these people were doing the front month contract. They thought, well, I thought it would kind of average itself out. Now they did change, so good news for people that are holding USO. They did change how they use the contracts for oil, but as Nate's pointing out here, if you want to participate in oil, the most direct way to do that is through the futures. So you can see that the actual price of oil using is that the June contracts, Nate?
This is the July. Mm-hmm.
July, thank you.
Mm-hmm.
Using the July contracts, it's a very different story than if you were to look at one of those products like a USO. So when I see what's happening in the market, I think I have a reason for pause. But if, and this, correct me if I'm wrong, but I was reading Liz Ann's article. The Fed is not opposed to continuing to pump more money into the system, as well as Congress being willing to continue to pump more money in the system. So with those two things, if you just keep handing out money, that kind of keeps the market afloat. Would you say that, Nate, or maybe help me understand a little bit better?
Yeah, no, hey man, I'm certainly not the guru on that type of a topic because we're in unprecedented times. But I'll say this: what crosses my mind is that yes, okay, it's great to see the liquidity the Fed is providing. It's great to see the fiscal support that's there. I think no doubt that they will continue to provide that support and till they feel like the economy is doing okay. But it is a bit of a stopgap. We are going to go to a new economy. I don't know what unemployment's going to look like at that time. Also, keep in mind the Fed's going to have to take their foot off the pedal at some point. Markets generally don't like it. They usually love it when the Fed is coming out and bringing out the helicopters and throwing money everywhere. But then they throw a little bit of a tantrum when the Fed tries to go the other direction. So the Fed has to be now even more careful in the manner in which they kind of back out of the stimulus they're providing.
Good plug for the temper tantrum, by the way.
Yeah, but it's I don't know. To me, it feels like, okay, well, now that you've opened the Pandora's box in terms of liquidity, if we didn't do it in 2008, well, we're certainly doing it now. They have a lot of leeway, and Chairman Powell conveyed this as well. He said basically we've got a lot more that we can do. They haven't they have not unleashed all of their firepower, but they've indicated that they can. They've made it available, and I think Kathy Jones put out an article about that. But that their ability to be able to talk up the market has been what's been propping up the asset prices, rather than really unleashing all of the firepower that they have. So there's still a lot that they can do. So yeah, certainly that's a point. I think the market, there's no way the market is where it is right now or continues to do what it's doing without that type of language coming from the Fed, and what appears to be what will be coming from the fiscal side of the equation as well.
Yeah. Anything that you're looking at as the Fed's talking? I know you're digesting things and you tend to take a deeper look at what's happening in the markets. Is there anything that you're listening for that you're like, this would be an indicator to me of watch out for bearishness or continued bullishness? Anything that they could say that would pique your interest?
Well, Jeffrey, we talked to a couple months ago when I was saying, hey, I would be kind of looking for one of these four things. Number one, and not to bore everybody on the call or you, but those four things were just those three, candle patterns, be it your big your gap up and your bearish engulfing candle, something like that, or your tombstone doji, or your shooting star, one of those dojis, or you sell off on good news. And the market's been doing exactly the opposite of that. It's like the worse the news is, the more the market continues to
Yeah, right.
melt up. It's really shocking, because not only with the civil unrest, putting the tragedy of that aside, just the economic implications of it, you could say, well, maybe it's not that big of a deal. But what's also going on that kind of caught my eye is that, hey, this is really affecting Trump's ratings or his re-election probabilities. And the market doesn't even seem to be fazed by that as well. And we're not bringing politics into it, but from a market perspective, that would be viewed as a negative if the Democrat, Biden were to win over Trump as we go into those elections. But the market doesn't seem to be concerned about that either, which I find a little bit surprising. So, gosh, what am I looking for? I'm just really nimble. I'm continuing to kind of play the trend, but very lightly. I'm tiptoeing into the room and picking up the small piece of candy and then going out very quickly.
I love that analogy.
Because I feel like that the market you could get a 3 to 5% correction on no news, or just because some profit taking or just some mean reversion happened to kick in. So I'm just very cognizant that could occur. Having said that, it looks like when I see something like this, Jeffrey, I wanted to get what do you think? If with 3% or whatever it is away from all-time highs, do you feel like there's kind of a magnet that the market wants to go see what the Nasdaq's made of and whether it can register a new high just to get that print? It almost feels like. Go ahead. Yeah.
I was going to say, yeah, I think you hit the nail on the head, my friend. And, the market's like, well, let's see how high up we can go before people start pulling off this trade. Once you hit that blue line, that resistance that you put in there from the previous high that we had back in early February, once you hit that price, that's really where there's an inflection point in the market. Do we go higher? In which case, you might see something more sustainable on the NASDAQ, the S&P, the Dow, maybe it might even impact the Russell as well. Or if it hits that high point and starts pulling back, NASDAQ might experience, let's say, like you said, a 3% pullback, but I would anticipate that 3% in the NASDAQ translates to something greater in the S&P 500 and the Dow. So almost like a leading indicator, the NASDAQ seems to be where people are keeping their attention. And I would say, and I'm sure you probably have the same line, within the next 2 weeks, we should have a definitive answer on that point.
Yeah, no, I do too. I feel like, and look, I'm not trying to put too much into Zoom's earnings, but sometimes when you get the moves that we've seen, so I don't know, did you see, for example, like Zscaler, cloud company, their earnings were good. They weren't 30% good in my opinion on the stock price. I am just really shocked to see how much money flow is going into some of these cloud names. We saw Zoom, which up until it really did this candle right here, and broke out, I think that probably got some short covering. But there's a lot of exuberance, it seems to me, around, hey, we got a new economy. The money feels really safe going into these cloud plays. Let's keep an eye on Zoom. Let's see what the earnings are. Let's say that they beat and then the stock gaps up tomorrow. I would just say keep an eye on it. If you get a reversal there, it could trigger some profit taking in some of those other cloud names. I'm not saying that's going to happen. I'm just saying be mindful of that when you get some of these parabolic type moves and this exuberance it feels like that's around a company like Zoom. So we'll see. We'll see. I mean, it's really hard to. I don't know about you, Jeffrey. For me personally, given the environment we're in, given some of this artificial ingredients, so to speak, that we're getting into this, and that via the Fed and the fiscal support, et cetera, and the no precedent that we have to really rely on, that it's really hard to predict these things going out a week, 2 weeks, or whatever. That's why I try to remain humble, try to remain nimble, and just look for some of these reversals. Even today, though, I would have thought with this reversal, when we were talking about the NASDAQ, that I was like, oh yeah, this probably has got some legs. The NASDAQ has just been melting up. And I was just really shocked to see this. So I'm like, wow, okay. I don't know if I feel like I have an advantage, in terms of trying to predict where the next, 24, 48-hour move is going to be. So I don't know. I stay light, my friend.
Yeah. Well, going back to Zoom and talking about exuberance, this was back on April 7th. At this point in time, April 7th, Zoom's market cap was more than 1/3 above Workday's. But Workday has nearly 6 times the annual revenue that Zoom does. So I think that just lends to, this is where people's minds are at. We're trying to get so ahead of the curve that we may be putting the cart in front of the horse. And I would be a little bit cautious, as I am, and as I'm sure you are, in what exactly happens. So what are some of the things that people might be doing? Well, make sure you're rebalancing. Don't rebalance every day. I'm not saying that, but if you haven't rebalanced in, let's say, a year, now might not be a bad time to do that. And if you're somebody that's trading, if you think that things are getting a little heightened, a little bit worrisome, scale back your position size or tighten up your loss limiters, whether it's stops or buying protective puts. But just be mindful of what's happening in the market and that disconnect that we see between the economy itself and what's happening in the stock market.
Yeah, good points there. And Ning out of California is asking, what are some of those ways you might kind of reduce some of your risk? Ning, I might cut my normal trading, whether it's contracts or shares, by 50%, for example, something like that. It depends on the situation. It depends on the stock. I understand there's probably going to be the potential for overnight risk more. But Jeffrey, what might you do if this environment's a little bit more uncertain? What kind of adjustments might you make?
I'm tightening my stops. For sure. Yeah, I'm tightening them because the nice thing is, if we look at the S&P 500, it's tightened up. And I don't know if we can easily add Bollinger Bands onto the S&P 500, but you can see the volatility has started to be taken out. And that's a good thing if you're somebody that's like, an options trader. Let's say you're doing credit spreads. You're seeing this nice tight range, which is great because you're just going to continue to make a little bit of money, a little bit of money, a little bit of money. But if I were in the position of, let's say I'm taking a trade on the S&P 500 here on the index itself, well, I would be much tighter on my stops than I normally would be. Because again, that Bollinger Band, that 2 standard deviations up and down, is tightening up. And generally, when you see it get really, really tight, there is some situation that creates, as a catalyst, an increase in that volatility. So whether that be up or down, I don't know. But in this case, if I were to be trading like the S&P 500, I might tighten up my stops. Maybe I'm only going 2.5% to 3% down instead of doing something like a 4 or 5%.
Good calls. I like that. Yeah, nothing wrong with, it really is about, I know there's probably some frustrated individuals on the sideline that are watching the market go up and they feel like, wow, this thing is not pulling back. It's kind of getting away from me. And every day it's going up. I get a little bit more antsy and I want to get in and I want to put money to work and I don't like to see all this stuff going up and I'm not participating. But I think it's a good reminder just to kind of, try to sit back, let the trade come to you, tighten up those stops. You want to have a winning trade. Where can I get a winning trade? Don't think, where can I get a home run and get a new car out of this next trade? It's like, I want a winning trade, a winning trade, a winning trade. Just kind of keep that mentality even as the market is doing this, and be willing to actually go either bullish or bearish. Now, if you don't like going bearish and you cannot trade short, or you don't like buying puts or put spreads or doing anything like that, no problem. Go to the sidelines when it's in one of those consolidation periods.
Yeah. So what about Stan from New Jersey's question? He says selling a spider put about 5% under what it's trading now, going out about 60 days was the question. So
yeah, let's take a look. Yeah, that's a good question.
Okay. Oh, he says sorry, I meant buying an SPX put. Okay, so basically what you're protecting is the next 60 days worth of activity. And so you're saying, how could I hedge myself? Well, we could take both sides of this. So, sorry, Nate, you can go ahead and answer that question. I apologize.
No, yeah, no, if you want to go ahead as well while I'm bringing this up.
So what I would look for is, and this is what I do when I'm teaching folks about how to trade options and when you're looking at different prices, the general rule, and I got this from a book called Options Trading, oh gosh, what is it? Options as a Strategic Investment by Macmillan.
Mm-hmm.
And
that's a big book.
it's a thick one. Yeah, it's not light reading. What he suggested is, if you're looking out, whether you're buying or selling, the general rule is about 1% per month. So if I'm going to be buying going out for 2 months, I'm going to look to pay about 2%. I would think, given the market's environment and what the S&P has been doing, I should be paying less than that. But that's not always true. There can be a disconnect between the markets themselves as well as the options, the derivatives that trade under them. So if you're going to be going down, I would say, so the seller of the puts, first, this one's to you. If you're selling a put saying, I want to get in, I want to generate money now, look to where you'd be comfortable buying it first. Find a price that you're comfortable buying it, then come to where Nate's at on Street Smart Edge and say, are they paying me enough? Going out 46 days, they're giving me easily more than 2.5%. So yeah, they are paying me enough if I'm a buyer. Excuse me, I apologize. They are paying me enough if I'm a seller. If I'm a buyer, though, I may be paying a little bit too much for those contracts. So maybe I drop it down a little bit. Maybe it's the 300 price that's really captivated my attention. But for the sellers, you're actually getting some pretty decent premium given that the market is still continuing to go up. For you buyers out there, the market has not started discounting these options, at least from what I'm seeing, even though the stock market continues to rise.
Yeah, no, good points there, Jeffrey. And Stan, I'll chime in. I'll just say this, that, okay, so you're thinking about buying a put, going out 60 days. I just pulled up the July. I didn't find one that was at 60 days. Maybe the SPX probably has another expiration that would be, here, let me check real quick. Let's just use the SPY for purposes of, for exemplary purposes here. We'll go 46 days out. So Stan, if you're going to look to buy a put that's 5% under the S&P, your market timing, number one, just realize that, meaning if the market continues to melt higher, then you're just going to watch the put kind of bleed. Number two, I'll say this, is that when you get that sell-off, what I've noticed is that the buyers tend to step in after, 48 hours or so, meaning like 2.5 days. The corrections have been something of the magnitude of 2.5 days. So just be mindful of that. If we do get a pullback of, let's say, 2-3%, in this environment so far, at least based on the recent